Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, November 21st, 4:45 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, continue to be in a bear market rally. You see over here on the trend gauge, leaders still holding up fine, still got plenty of good setups above and around the 21-day exponential moving average, but we're going to need the market to break out of this area if they're going to make any progress. You can see we're still in bullish slash uptrend mode for our intermediate term time frame. That's versus the 50-day moving average, and our short term time frame versus the 21-day exponential moving average, and a lot of tight action over the last 5 days or so. The market only does one of three things. It either trends up, trends down, or consolidates in preparation for one of the trends, higher or lower. Bulls obviously hope that the recent bounce off the lows, this consolidation will resolve in that direction. Bears say, just take a look at what's going on with all the macro data and the recession next year. We're going lower, but we let price and volume dictate for us. Long term, we're still, for the most part, stuck below the declining 200-day moving average, but getting kind of close to it on the S&P 500. We'll take a look at all the charts momentarily. So what just happened today? Tight chop around this 3950 level on the S&P 500. In fact, that's exactly where we closed, was at 3950. Although we're showing red on the day, I really don't consider it a negative day in any way, shape, or form. I really didn't see any damage done to any charts, and just a low volume. It's almost like you'd think it was a holiday week or something like that, with the lack of volume and tight action. And well, in fact, it is a holiday. The market will be closed on Thursday and open a half day on Friday for Thanksgiving. So let's get through things now. G6 down 1.3%. Value continues to outperform growth. S&P 500 down 0.4%. NASDAQ 100 down 1%. Dow barely down a fraction, 0.1%. Mid caps down 0.24. Russell 2000 small caps down 0.6. Global diversified 60/40 stock and bond down 0.33. In-house, our GROTECTION flagship portfolio down approximately 0.37%. When we go to the tail of the tape, we'll describe what kind of mode we're in, and we'll go through charts of interest. But first, let's get into remember the trend gauge here, and let me give you our overview of what we do here at Revere. We are a registered investment advisor, registered with the SEC, conflict of interest free. Our flagship portfolio is GROTECTION. We're an active manager. We seek to grow assets in an uptrend, protect them in a downtrend, and we determine this by looking at where leading stocks and the major indexes are relative to their short-term 21-day, medium-term 50-day, and long-term 200-day moving average. When they're trending above them, we are fully committed to the market. When we start to go sideways, our stops will take us out. If we start to trend lower, we'll see the slopes of the line rolling over along with price. And if we break the black line, that's the 200-day moving average. That's when we are in a maximum defensive posture, and that is because of these stats here. All 13 of the bear markets going back to 1968, they all happen below the 200-day moving average. Now, you don't know if it's going to be just a run-of-the-mill 20% correction or a severe bear market, such as you saw in 73, 74, 2000, 2002, 2007, 2009. Is 35% severe for you? That's what we saw in COVID. How about this year? Is that severe enough? 27.5%. Well, we've got rules to dodge these and then to get back in the market when it goes to a more healthy posture. And when you do that, not only do you sleep better at night, but you're capitalizing, or you're compounding from a much higher capital base. If you're interested in an approach like this, give me a shout. Email me, don@revereasset.com. Our phone is 855-REAL-WEALTH. That's 855-732-5932. You can also email my partner, Dan Stewart, dan@revereasset.com. Dan is a CFA and president of Revere, and he is Mr. A to Z when it comes to all things financial. He will answer any questions that you have. So getting back to the market, here's the S&P 500. Let's go to a 60-minute chart here. We've been talking about this 3,900 area as the lower end of support, this 3,950 intermediate term support. We're just really consolidating around there. Resistance is this 4,007 area. That's a big fib retracement level of the most recent move down, this third leg down on the S&P 500. Which went from the beginning of August and bottomed on October 13th. And we're consolidating now. And as I said earlier, we want to see consolidations should resolve in the direction of the primary trend, and that direction is higher. If you look at a 15-minute chart here, this is the big gap up on the CPI report, followed through one more day, and then we've just been chopping 1, 2, 3, 4, 5, 6 days, all within the range of those, basically of those days, with one poke of our head above. That got us above that 4,007 level, but we failed. That's the key level that we want to get above, and then try to take a shot at the 200-day moving average, which is still dropping about 3 points a day, currently at 4064, 4065. 2.8% away on the S&P 500. Now, this going sideways has been good because the 21-day is now only 2% below, so we're catching up to it. So basically equal risk reward above and below for the key moving averages that we track. The declining long term for resistance, the short term coming up to meet price. That's the 21-day. And let's go to the NASDAQ 100. This has been lagging badly. You can see rolling over here on relative strength, still above its 21 and its 50, which are now stacked right around this 277, 278 level, well below the declining, still 8.5% below the declining 200-day moving average. Let's go to the Dow Jones Industrial Average. This has been the leading index from a big cap standpoint as of late, consolidating 7 days since its gap up on CPI, very tight range below this 34,000 level. MDY led for a while, but mid and small caps have been lagging over the last week and a half since this big gap up. But again, consolidating tightly right above the 200-day moving average. Frankly, that's what we want to see, is these the rest of the indexes get above the 200-day moving average here. Let's look at small caps. Tried to get above last week, but now 4 closes below. Couldn't quite make it, but something's got to give here because you got the 21 below, the 200 above, very similar to what we're seeing on the 50-day moving average, but much tighter on small caps. Maybe this resolving of this in one direction will give us a peek into what's going to happen with the large caps. Let's go to a couple of other key charts here. Here's the even weighted S&P 500, just barely down a fraction today. That tells you again, when you see that, first thing you're going to think is big cap tech lagged. Yes, it did. NASDAQ 100 was down 1%, and those heavy weights in that are what weighed down the S&P 500. And I'll bet you'll see XLC, K, and Y negative on the day. And yeah, you'll see that when we get to the tail of the tape. So how about the equal weighted NASDAQ 100? Down 0.6%, still lagging, but not as bad as the market cap weighted NASDAQ 100. What did the VIX do today? Despite the indexes being down, the VIX was also down. This is a tailwind for stocks. If stocks would just get the message that you can go up when the VIX goes down, which is the normal relationship between these two, trending below all the moving averages. And hooking back down after a little move up back into oversold area here. So before we get too oversold, we're going to want to see the indexes make a move here. How about the dollar? UUP popped up today. This was really what weighed on stocks, that inverse correlation that we've been seeing. 6-day tight consolidation of the dollar was enough. Popped up, kind of hung in a tight range, but it started up 0.8 and it pretty much closed up 0.8. You can see the stochastic hook up from oversold. That's not good for stocks because, again, of the inverse relationship that we've been seeing. How about TLT? Tight range, 4 tight closes sitting right on the 50-day. How about yields? What are they doing? Here's your 30-year yield, up on the day just a bit, 0.18%. How about the 10-year? How about the 10-year? Did I bring up the 10-year? Okay, that is the 10-year, up 0.18%. How about the 30-year? That's the TYX. That was finished at the top of the range, but down on the day, and that's an oversold territory too. What else is key here? Let's take a look at GLD. Gold pulling back after this gap up in 4 straight days up. No consistent move on gold here. Volumes lighter on the pullback, but only price pays, unfortunately. So any hopes for the gold bugs that we might get a strong move, that's fading quickly. And faded really over the last 3 days despite the consolidation. Today's relationship kind of makes sense, but versus the dollar, but kind of a disappointment there for gold. BITO, this is Bitcoin, not good. Let's go to the 60-minute chart. As you can see how tight this has been, making a lower low since all of the SBF and FTX nonsense going on here. I'm fighting a cold, pardon me. So Bitcoin obviously not looking good there. So let's get to the tail of the tape, and then we will get to some individual charts. So bear market rally. From a stochastic, the technicals are mixed. Stochastic indexes are basically mixed. G6 is lower because growth is lagging. NASI and RSI positive. Dollar below the 21, oversold. TNX and TYX below their 21 and their 50. Put call down to 0.86. VIX down 3.3% to 2236. Operating under the bear case here with the big gap up on CPI, but no further price progress. In the news today, kind of some significant news. Goldman Sachs and Morgan Stanley called for lower lows in early 2023 in the indexes, and then a recovery into year end, but basically flat for the year. So all of these big broker houses, wire houses will be coming out with their predictions. They're not worth a damn thing. More news, China, additional lockdowns that hit oil, and then there was a report out, oil was already down pre-market, then another report came out in the Wall Street Journal saying that OPEC was going to raise production, and oil was down quite a bit along with all the oil stocks. And then Saudi Arabia came out and said, we're not, that's just wrong. And oil rebounded quite a bit, still finished. Oil USO finished flat on the day, nat gas up 6%. The oil stocks recovered 2/3 of their losses on the day. You just can't believe what you read sometimes, as much as we would like to. Day count, we went from up 1 to up 1 with a consolidation. This is Thanksgiving is a historically bullish week. Certainly didn't act that way today. Acted just like summer doldrums, kind of. So we'll see what the rest of the week brings. Market closed Thursday and a half day Friday. Our expectations are still positive after CPI. As long as we stay above 3,900, we're consolidating around 3,950. Tight range chop all day around that 3,950 level. Dollar up all day. ITA outperformed. KBE outperformed. The underperformers were here, CKNY, all the tech-related stocks, semiconductors, software, biotech, and oils, although they did recover quite a bit. We'll go over the focus list charts in a minute here. In-house, all we did is add around this 3,950 level to our S&P 500 long. We've now got 13.3%. That's the equivalent of 40% long the S&P 500, in addition to our 6 longs, and we'll look at those charts too, plus our oil ETF long. But the bottom line is tight range chop all day around this 3,950 area. May just do this all week, don't know. And we keep our positioning in a situation like this below the 200 but above the 21 and the 50. We want to be between 0.6 and 1.0 on our volatility adjusted beta. and that's where we are. The charts of everything that we own, no damage to them today. A lot of damage early to the oil chart, but it recovered by the end of the day, and our stop wasn't hit, so we stuck with that, and fortunate that it recovered. So let's get to some individual names here from the focus list. SHLS, this new solar stock that's come on the scene, continues to be volatile, but not giving up any of its gains from the gap up, consolidating above the pivot from this flat base. Celsius, we bought this last week. We'll add to it if we can get some move off of here, but nothing wrong with this today. Tight range, consolidation, lower volume, right above the 80 MA is fine. AEHR still has the look that it wants to be a leader, holding up just fine. Nice pullback, actually. Touched the 21 last week. That would have been the spot, or approached the 21. That would have been the spot to get in, but biding its time until the market decides what it wants to do. ON Semi, same situation, consolidating here after a strong move up, strong pullback, bounce off the 21-day, 2 tight days on lower volume since then. Boeing, still keeping a tight eye on this. Pulled back some today, tight range, lower volume really tightening up here, right above the 8 EMA. Apple's got to contribute if the market's going to go higher, and it's just consolidating around and above its 50 and 21-day moving average, which are about to cross. Below the 200-day, note the positive volume patterns, up on blue days, down on red days on much lighter volume than the up days. Couple new ones to take a look at. PODD, this is consolidating nicely at the bottom of the range here. This is an insulin company, consolidating nicely since its earnings gap up. And SANM, same situation. SANM, earnings gap up, consolidating very tight after a shakeout last Friday below the 8, and then it recovered. And then if the market's going to roll over, we're keeping an eye on SARK as a short for the ARKK. Kathy Woods, ARKK, which just can't get out of its own way. Let's take a look at a 60-minute chart on here. So this was up 24% in 2 days, was just a massive short squeeze, and basically it's given up 3/4 of that over the last 5 days as the stocks just continue to be garbage. I know one of them reported after hours today. Zoom, one of the top 10 holdings. What's that doing? Zoom is Zoom. Let's see if we can get a quote on this here after hours. Down 5.5% after hours. So no help there. So the rest of the things that we're holding in the portfolio, ERX is the ETF for oil. Big shakeout underneath these recent lows. Recovered, closed right on the 21 by the end of the day. Any further weakness will be out of this. Any follow-up to that weakness today. The other things that we continue to hold, Mobileye had a rough day today. This was the negative in the portfolio. Closed above 28. It's going to get a 21-day exponential moving average here in 2 more days, and then we'll see where it is relative to that. It's actually consolidating right above its 17 exponential moving average, which I've heard that some CanSlim aficionados like to pay attention to the 17 EMA, but that's not on my to-do list. Let's look at PI, Impinj. Tight consolidation day with a bounce off the 21 last week. We're still holding that. Steel Dynamics was the standout today, making higher highs on above average volume. Great volume patterns here, just riding the 80 EMA higher. Looking good, Steel Dynamics. First Solar, consolidating near its all-time highs, looking good there. And finally, GFS is our 6th position. These are varied in size from 1.5% to 4%. A 4% is basically a half position. A 1.5% to 2% would be a quarter position, depending on the volatility of the stock. Tight pullback for GFS at the top of this base today. So we like the names that we're in. We just need the market to cooperate for them to do anything. And I think that's going to wrap it. As always, like to hear from you. You can email me, Don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, folks, it's not how much you make in the market, it's how much of that you can keep. We are off the lows after a severe, 27.5% drawdown off the highs year to date. Nice bounce on 1013, taking a couple steps forward and one step back each time. We're in the process of taking the half of a step back now, and we're just waiting for the market to decide if the next move is going to be a break below this 3,900 level, which is support, or a break above this 4,007 level and into the declining 200-day moving average, which is where the rubber will meet the road. That's what we're keeping our eye on. So wrapping up Monday, November 21st, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.